Hi, Larry Gaines, Power Cycle Trading. Well, in this video, I'm going to show you a real simple and easy and quick way to hedge, a cheap way to hedge. We're in this market with a lot of potential for more downside risk, but you're also, when you're looking at hedge and buying insurance, you don't want to pay a whole lot for the insurance policy, right? So one really good easy way to hedge using options is to do what we call a directional butterfly. So what you want to do is look at your charts, okay, and then you want to see, okay, where is the potential for this market to go next? So this is the S&P, SPY, ETF, and if we look here, we see these are reversal signals. So the market's coming off. The first level of support based on prior price action was right here today at 286 basically. Now if we break the 286, the next level of support is right down here. You can see a lot of price action here, and here's another major moving average right there, the 21 period. So this is a weekly chart. So the next level is 280. All right, so that's going to be the same if we look at SPX. So let's take a look. SPY, next target will be right here at 280 if it breaks 286. And for SPX, it's going to be 2800. So let's take a look at that. So on SPX, it's 2800. So I show you this because it depends on your account size. If you have a small account, you could hedge with SPY. If you have a bigger account, you can hedge with SPX. So if we're targeting the next target down, if this area here breaks, we're looking for 2800. So what we can do is we can set up a butterfly for a target at 2800 or 280 for the SPY. The next thing is I'm going to look to go out using the monthly option series. So this is going to be where all the price action is. So this would be the 17 May series. And this also, based on the implied move of this option series, gives an implied move of $8. So this would put you down to 280. So this is the one that you could use. So if we go in here and we did this butterfly setup, you can see how cheap you could get this done. So this would be buying the 284 put, selling the 280, then selling the 280 again, buying the 276. So this is what we call a butterfly, a 1x2x3. All right, it's just a balanced butterfly. But the beauty of this is, okay, so let's say it breaks 286 and it starts doing that tomorrow, the 8th. So you can see it's pretty flat, but if it breaks this 286 area and heads straight to 280, you're going to be up $30. Well, that doesn't sound much, but your risk here, your only insurance premium is 28 bucks. So you're going to be receiving back 100% return, so that's 28, you're making 30 bucks. So you're going to get back that full cost of your insurance plus $30. Now, if this was to happen next week, let's say going into next week's expiration, the monthly, so if it happened next the 15th, and we're down here trading at 280, you're going to be up $80. Your cost is 28. If it goes into expiration, which is usually the case, on Friday the 17th, the 280, you're going to be up as soon as the market opens up at 145 profit. If it was closed into the close up here, what we call the top of the tent, you're going to be at $368 on your insurance premium of $28. So the maximum $28 is all you have to risk, but you have a lot of insurance premium to collect if the market moves down. And so the same thing with SPX if you're having a larger account. So if you have a larger account, if you do one contract with SPX, that's equivalent to about 10 contracts at SPY. So this 280, 2840, 2800, 2760. So that's the same basic butterfly, but using SPX would cost you $2.70. So roughly, 28 cents was the SPY. This is 10 times more, $2.70. That's your maximum premium or risk. And you can see that next week, if you got into next week on the 17th and you're trading on the open at that 2800, you're going to be up 1500, 1400 bucks. If into the close, you could be up, the max profit would be $3600. And let's say this setup, you did this tomorrow, Wednesday, and you come in Friday and the market's cratered to the downside and we're trading at 2800, you're up $375. So a really great way to ensure some of your downside risk if you want to, and very, very cheap way to do it. Now, if you'd like to learn more about this type of strategy and other strategies similar, come join us. You'll see a link here on this email to join us for this Saturday. I'm doing a free webinar on what you need to know about options and the strategies to use. So we'll be covering the butterflies and the long condor. So two of my very favorite strategies. So join us for that. That'll be this Saturday, May the 11th at 11 a.m. and it's free. So come join us and learn more about this type of insurance strategy, plus a way to use it for profits and income and everything else. Plus, check us out with a lot of good trading material and new content here. We've got pairs trading articles, option butterflies, do options lose value over the weekend, just posted that, control your mind, options to predict stock price. A lot of great content here. So come visit us at powercycletrading.com.